The following video is an extract from the Udemy course, Learn to Construct Financial Statements from the Ground Up. If you would like to purchase the full course, you can do so by using the link below. Our third primary statement then is the cash flow statement, and this might be the first time you're introduced to the cash flow statement. The cash flow statement sets out various cash inflows and outflows to reconcile the opening cash position, that's the cash at the beginning of the period, and the closing cash position, that's the cash at the end of that accounting period. The cash flow statement is effectively prepared on a cash basis of accounting. So remember, we said the income statement is prepared on an accruals basis of accounting. So therefore, in preparing our cash flow statement, there needs to be a reconciliation to take our income statement result, which is prepared on an accruals basis of accounting, to a cash basis. So we're going to just show you an example of that reconciliation process in the next slide here. So what I would say, this may be the first time you've been introduced to the cash flow statement. So we're just going to go through some concepts here to tease these out. But don't worry if this doesn't make sense to you at the moment. We will get there. When we prepare these financial statements from the ground up, you will become familiar of how a cash flow statement is prepared. But just some things to draw your attention to at the moment in a cash flow statement. In this one, we've got cash at the beginning of the year. So this is a new company, so they had zero cash at the beginning of the period. And then the cash at the end of the period was 23,055. So what we want to do here, the cash flow statement reconciles the cash from the beginning of the accounting period to the end of the accounting period. So what we do is we've got our income statement profit, which is prepared on an accruals basis of accounting. And we said before, the accrual basis of accounting does not necessarily reflect a cash basis of accounting. So various adjustments need to happen to arrive from the income statement profit to the operating activities in terms of the cash generated from the operating activities. Some of these movements are set out here. We'll not dwell on these too much at the moment, but we will get to those. But effectively, these adjustments take us from an accruals basis of an accounting in terms of the income statement result to then what we can say is the cash generated from operating activities. So that's our first classification in the cash flow statement. The second classification of cash flow movements is then cash used in investing activities. So for example, purchase of tangible fixed assets is an example of investing in a business. So that there was 6 million in this case was spent on purchasing fixed assets in terms of investing in the business. And then our third classification in the cash flow statement is cash generated from financing activities. So in this case here, in terms of financing the business, there's cash raised from issuing shares and cash proceeds raised from issuing debt. So that was 25 million in this case. So what we have done here, we have got our cash at the beginning of the period, which is zero. We have calculated our cash generated from operating activities, and you can see that 4055. That was an inflow. In terms, there's been an outflow of cash used in investing activities in the business, and then there's cash generated from financing activities. And when you sum all those up, we arrive at the cash at the end of the period, and that effectively is what the cash flow statement does. So that's just a bit of an introduction, and we'll go through some of those more tricky concepts through the duration of the course, but I thought it was important to tease that out now. By way of summary then, we've got our three primary statements: the income statement, the balance sheet, and the cash flow statement. The income statement is prepared on an accruals basis of accounting and reports on revenues less expenses to give a profit or loss over a period of time. So a period of time should be remembered for an income statement. Our balance sheet is also prepared on an accruals basis because the balance sheet and income statement are linked. It reports on assets, liabilities, and equity at a point in time. And then finally, our third primary statement is the cash flow statement. It's prepared on a cash flow basis of accounting, and it reports over a period of time as well. It shows the cash inflows and outflows between cash at the beginning of the year to cash at the end of the year. And in terms of how those cash flows are classified, they will be classified in the following categories: cash generated from operating activities, cash used in investing activities, and then cash generated from financing activities. So pause on that now, and you can reflect, and you can watch any other aspects of this video if you need to, but I will see you over in the next lesson. Thank you.